Hello, this is Stefan So, Chief Investment Officer with RVW Wealth, and thank you everyone for joining. We have visitors from all over the country with us today, and it is my pleasure to welcome Jack Manley, Global Market Strategist with JP Morgan Asset Management. Good to have you, Jack.
Thanks very much, Stefan. It's great to be here.
Yeah, and good to have you with us, and we're very much looking forward to learning from your insights. And today we'll be discussing topics such as growing importance of impact and sustainable investing, the fourth industrial revolution, and integrating tech into every aspect of life. As you could see now, we're using some amazing technology to host this live, and where everyone from all over the world could log on, and the economic and political impact of evolving relationship with China. And as our clients are aware, we're data-driven advisors and focused on evidence-based investing. Now, I've been part of RVW Wealth for over 5 years now, and as a senior member of the team, we are proud to say that we're pure fiduciaries and avoiding all conflicts of interest when designing the best portfolio for our clients. And our investment funds are well positioned for the changing economy. And as an example, and Jack, you could probably relate to this, we use a quality factor fund from JP Morgan, which is focused on some of the important factors like profitability, quality of earnings, and solvency. And these are some of the more fancy terminology that might be used in the finance world, but how did this actually work out for the actual underlying holdings? The General Electric company, once one of the most valuable companies in the world, was excluded from this quality factor area due to poor fundamentals. Their cash flows were declining, too much debt, and in the past 3 years, the stock was, it's been down over 60%. So examples like this shows the value of quality tilts. So Jack, before we go into some of the important slides that you have prepared for us, there's just a lot of discussion about will it be a slow recovery, or is there just so much pent-up demand? I mean, we've seen some of the data as it relates to travel and things like that. So can you point us to the right direction in terms of what you're seeing in terms of the data? Is there actually pent-up demand, or do you think there's going to be a slow recovery?
Yeah, Stefan, I mean, it's an incredibly important question. It's one that we get all the time. And I think ultimately the answer is going to lie in terms of your time horizon. I mean, we certainly think that there is a whole lot of pent-up demand out there waiting to explode, but we don't think it's going to explode right now. And that's something we'll get to. We'll kind of work through the idea of where growth is going throughout the course of this year. But if you look at something like, say, the unemployment rate, take that as a proxy for pent-up demand. The unemployment rate right now is 6.7%. Now, that's very high. But if you actually track it back over time, it's around as high as it was back in 2014, right? So like a non-recessionary year, we had an unemployment rate of around 6.7%. But what is unusual right now is that the participation rate within the labor force, so the people that are actually participating in the labor force, it is lower than it was a year ago. If you add all of those people that have dropped out of the labor force because they are discouraged by current conditions back into the labor force, and then include them in that unemployment rate calculation, the unemployment rate moves up to almost 10%. That's a lot of people out there on the sidelines. That's a lot of pent up demand. When these people get back to work, when their jobs come back, they're going to have money to spend. They're going to have vacations to take, flights to take, restaurants to eat at. So I do think there is this explosion coming. I just don't think it's happening right now. And certainly something we can work through as we talk about the overarching themes of today's discussion.
Right. And Jack, one other point to that, you made some great points. And obviously, certain sectors were affected much more than other sectors. What are your thoughts on some of the comments that lead to some of the ideas that maybe the economy is completely detached from the stock market? Well, if you see certain sector performance, I would argue differently. But any comments around that area?
So I would say I would actually agree with the idea that the economy and the stock market are disconnected, but I don't think that's necessarily an error. I don't think the stock market has to be a reflection of the economy. The easiest way that I have to describe it is if you look at, as you mentioned, Stefan, kind of a sector by sector breakdown, the biggest part of the U.S. stock market by far is technology. And that is one of the themes of today's discussion that I'll be sure to weave into the broader commentary. Technology represents almost 30% of the U.S. stock market. But in terms of payroll jobs, like the number of people that are employed by the tech sector, it's like 3%. Now, to put this another way, the sectors that are the hardest hit parts of the economy because of COVID, so travel, leisure, hospitality, retail, they collectively make up around 20% of payroll jobs, around 20% of overall GDP, and around 7% of corporate earnings. So there's that disconnect again. And it's been like this for a long time. It helps to explain why the stock market did so well last year, why it bounced back so quickly, despite the fact that the economic situation is still not back to where we were before COVID. So another thing, certainly, Stefan, comes up a lot, and I think you can sort of work your way through it and help to justify it. Doesn't mean that it's any easier to stomach, but I think at least you can justify it partially.
Right. Yeah. And those are great points, given that we saw the fastest bear market in our history, followed by the quickest recovery ever thereafter. So, Jack, we'll let you take it away. Hopefully we can post the slides and learn from your wisdom.
Okay, wonderful. Well, thanks so much, Stefan, and good morning to everyone. Thank you so much for dialing in. Thank you for the opportunity. Thank you for throwing the slides up. Before I jump in, I'll say, Stefan, I was blown away by the music choice for this morning. I don't know if you picked that or if someone else did. Sounded vaguely like John Williams. It felt like I was watching a Harry Potter movie or Indiana Jones or Star Wars. It was a great way to amp me up before today's call. So really, I do appreciate it. I hope everyone else enjoyed it as well. But with these slides in front of us, what I'd really like to do over the course of the next 30 to 40 minutes or so is go through JP Morgan Asset Management's kind of high-level assessment of where we stand now and what the future may hold. We like to say we don't have a crystal ball. We can't tell you exactly what is coming down the pipeline, but what we can do pretty nicely, I think, is talk about the present with a little bit of clarity, be able to see what's going on exactly for how it is and kind of game out where things may move in the future given existing conditions. Now, I understand that we have some themes that we'll be talking about today: the rise of China, the rise of technology, the importance of ESG, all of these long-term structural trends that are constantly being discussed by clients. They're only becoming more and more important. I'll be sure to weave these through into the broader commentary. But from an agenda perspective, there are really three big things that I'd like to do today. The first one is going to be talking about the state of the U.S. economy. So kind of giving a macro update, taking stock of where we stand from a macro perspective. We just came out of a very severe recession. We are in the midst of a recovery. What does that look like throughout the course of this year? And Stefan, that'll help to address that first question that you had asked about all the pent up demand and when we may see it. The second thing I'd like to do is talk about the risks to that outlook. And certainly there are some risks that have faded over time. 2021 is a lot more certain, I think, than 2020 was. But at the same time, there are some risks that persist. And so let's identify them and let's kind of walk through them. And I'll use that opportunity as a time to speak about the incoming administration, about the political composition in the United States, and how that relates to things like technology, how that relates to things like ESG, how that relates to things like our relationship with China. And then finally, kind of putting a bow on all of this so what behind the presentation, it's going to be the investment implications. So what all of this means for asset allocation. How do you put together a portfolio that is acknowledging all of these trends that we'll have discussed, that will be able to weather the risks that we will have identified, but will also be able to take advantage of some of the opportunities that exist out there, whether they are more recently created thanks to the events of 2020 or thanks to the shifting political regime, or if they are longer term in nature, more structural, more secular, things that we can look to maybe not in 2021, but over the next 10, 15, 20 years. And to do all of this, we are going to go through a handful of slides from our flagship product, the Guide to the Markets. For those of you that aren't familiar with the guide, it is a collection of around 68 pages, I think a little bit more at this point. We are certainly not going to go through all of them. I just picked out kind of the greatest hits, if you will, for the purposes of this discussion. With that, let's turn to the first page of this presentation, which will be page 22 from our Guide to the Markets. Now, I mentioned that my first agenda item will be taking stock of where we stand from a macro perspective. I think page 22 does a tremendous job of doing exactly that, specifically the left-hand side of page 22. Page 22 looks at real GDP, and on the left-hand side, we examine it in dollar terms. We show what trend growth looked like for the economy since the fourth quarter of 2016. And we show just how disruptive COVID-19 and social distancing was to the economy last year. We had that roughly 5% contraction in the first quarter, that 31% collapse in the second quarter, resulting in a recession that in aggregate was around 10% or so relative to the start of the year. Now, that is an extraordinarily severe recession. If you ignore the recession we experienced immediately after World War II as being sort of technical in nature, right? The United States demobilizing its war effort. Well, this was the worst recession we experienced since the Great Depression, which means that for most Americans, it was the worst recession we experienced in living memory. It actually made the financial crisis pale in comparison. The GFC was around a third of the size of the recession we just came through. And I think it's funny, we used to call that the Great Recession, but it doesn't really feel so great anymore after what we just went through. So without a doubt, that recession will go down in history for being just extraordinarily severe. But it is also going to go down in history for being probably the fastest recession ever. And Stefan, you had mentioned that rapid bear market into that rapid bull market. Well, the economy sort of functioned in the same way. The data really bottomed out in April of last year. And since then, things have been pretty steadily improving. The unemployment rate, retail sales, consumer spending, manufacturing activity, services activity, all of these things getting better since those April lows. It means that we've been in the midst of a recovery for a long time now, a whole lot longer than the recession ever was. And we got our first real evidence of what that recovery actually looked like just a couple of months ago with that blockbuster third quarter GDP print. 33.4% annualized growth. It was the single best quarter in U.S. economic history. And I think because of the combination of the speed of this recovery and the strength of this recovery, that there is a temptation to call what we just went through a V-shaped recovery. And I want to push back on that a little bit. And that's why I like page 22 so much. The left-hand side shows that this recovery we experienced started us on the way to a full V, but we're not there just yet. Even after that blockbuster third quarter print, we're still generating around 3% below where we were before COVID, around 6% below where we would have been if there had never been a pandemic, if we had continued along that trend growth line. If you want to put it in dollar terms, at the end of the third quarter of last year, the U.S. economy was still generating around $700 billion less than it was before the pandemic, and around $1.5 to $2 trillion less than it would have been if there had never been that pandemic. And so the point here, I think, is that we're not out of the woods just yet. And unfortunately, from here on out, we do believe that growth is going to be much, much slower. Fourth quarter growth should come in at around 4 or 5% thanks to a fairly strong retail season. Some of that pent-up demand, Stefan, that you had mentioned showing up in the holidays of 2020. But first quarter growth will likely be much slower. Second quarter growth will likely be much slower. We really expect that surge in activity to happen at some point in the back half of this year. And for that reason, we don't expect real GDP to get to where it was before COVID until sometime in the second half of 2021. I like to say that this recession may have only been 2 months long or so, but the overall gap in economic output is actually going to be closer to 2 years. And that brings us to some of the risks that we can talk about. And I think this is a good opportunity to discuss some of those trends that we had mentioned as well. So let's turn to the following page of this presentation, page 24 from our Guide to the Markets. Page 24 looks at a number of economic indicators that may not be as frequently cited by financial press. These are the parts of the economy that were most hard hit by COVID, the most sensitive to a pandemic, to social distancing. Things like traveler traffic as measured by the TSA, like seated diners at restaurants, like hotel occupancy. And what I think is so interesting about page 24 is that it becomes very clear that not all parts of the economy contributed in the same way to that blockbuster third quarter print. You look at things like getting on an airplane or going out to eat at a restaurant or staying at a hotel. They're still very much depressed relative to where they were even a year ago. And that's after this recovery story that we saw throughout the warmer months in the summertime. Now we are dealing with a very lethal third wave. The U.S. surpassed 400,000 COVID deaths just a couple of days ago, and we're moving into the colder winter months. These data are going to get worse before they get better. Now, they will get better, but I think that has to do with an effective rollout of the vaccination program. And certainly there is a lot to cheer about when it comes to the vaccine. We know that it has been started to get rolled out across the country, but we also know that we've hit some stumbling blocks already. And I don't think we should underestimate the logistical complexity of manufacturing and storing and shipping and distributing hundreds of millions of doses of these vaccines. It means that while the vaccination program is happening now, we likely won't be fully inoculated until sometime in the summer, maybe even the fall, which means that there are many, many more months to go until this pandemic is over, which means that unfortunately there are many, many more months to go of slower growth and of these particular sectors continuing to lag from a macro perspective, from an unemployment perspective, from a stock market perspective. And when we consider this risk that we are running out of momentum in terms of what the economy can generate organically in the absence of an end of this pandemic, while we are grappling with a very lethal third wave of COVID, it brings me to my next point, which will be on the following page of this presentation, page 29 from our guide to the markets. So if we could move forward to the next page, thank you. The point here is that we do have a pretty big gap that needs to be bridged between now and the end of this pandemic, right? At least 6 months, maybe even longer than that. And yet we are running out of steam. We are dealing with this third wave. The only thing that can really effectively bridge that gap is going to be policy, the policy response. And we know the Fed has been extraordinarily active in its monetary policy response. It cut rates down to zero. It restarted its asset purchase program. It has become that lender of last resort in a way we never thought possible. While we should applaud the Fed, I think, for its efforts here to shore up the financial system, we have to recognize the problems we've been dealing with and will continue to deal with until this crisis is over. They're not problems that can be solved by monetary policy. Right, we mentioned earlier the unemployment rate, it would be close to 10%. Well, it's only the Fed. The reason it's 10% is not because interest rates are too high. Right, there are other factors at play, exogenous factors at play, and that really puts the onus on Congress, and it puts the onus on additional fiscal stimulus. So if we look at page 29, particularly the left-hand side, but really the whole page, we can see how the fiscal situation is responding. We know that we got this landmark piece of legislation last year, the CARES Act, right? Almost $2.5 trillion spent to combat coronavirus. We know we got a smaller bill at the end of December, kind of like the CARES Act, but a lighter version, right? More support for unemployment, but a smaller stipend. More direct stimulus payments, but a smaller check. More funding released for small businesses, but more hurdles to go through to secure that funding, and more money for state and local governments, but harder to get that, and more directed specifically towards health-related issues, towards vaccination rollouts. Now, that stimulus we got at the end of December, I think is going to do a pretty good job of shoring up the economy for now. But just as with the CARES Act before, many of the most important provisions of this most recent bout of fiscal stimulus are going to expire in the not so distant future, right? That supplemental unemployment insurance that we have, that roughly $400, $300 a week from the federal government, that's going to expire at the end of March. And yet, as we've already discussed, at the end of March, there is still another 3, 4, 5, 6 months to go before this pandemic is truly over, before the unemployment rate can meaningfully move lower. And so what are we going to do to bridge that gap? Well, we need more fiscal stimulus. And that's where what happened yesterday comes in as very important. What happened a couple of weeks ago in Georgia. That comes in as being very important. So yesterday, Joe Biden was inaugurated as the 46th president of the United States. And a couple of weeks ago, we saw both senatorial elections in Georgia, I think, surprise a lot of us and go blue. So the Democrats have a unified government moving into 2021. Now, there is a lot of concern, I think, about disruptive policy change as a result of all of these things. But what I would like to remind everybody is that, first of all, Joe Biden is a pretty moderate centrist Democrat when it comes to a lot of his policies. But I think more importantly, the majorities that the Democrats have in both the Senate and the House are about as narrow as they possibly could be. The Senate is tied right now, 50-50, with the tiebreaker going to the vice president. So Democrats have a 1-seat majority there. In the House, there is a 10-seat majority in a chamber that has hundreds and hundreds of participants. And when you consider that most of the more disruptive policy changes that would go through the Senate require a supermajority of 60 votes or more, when you consider that there are some very moderate Democrats in the Senate and that Democrats only have 51 votes by party line, those larger changes are going to be very disruptive. The biggest implication, or rather, those largest changes are going to be very difficult to get through. Those disruptive changes will be very difficult to get through. The biggest implication, we think, is as it relates to fiscal stimulus. And that's because fiscal stimulus is a bipartisan issue. We saw just a week ago or so a new rescue package unveiled by the incoming Biden administration, roughly $1.9 trillion. It feels a lot like the CARES Act. It feels a lot like the package that we just got at the end of December, but a little bit more beefed up. More unemployment insurance, more direct stimulus checks, more support for businesses, more support for state and local governments. And while we may not get every single dollar of that passed, because I think that a lot of spending will require compromise in the Senate, despite the fact that we have a unified government, we do expect that money to go through. We expect that that safety net to be extended, and we expect the overall durability of this recovery to be held up fairly nicely until we can really get back on our feet at the same time. Now, I think this is a good opportunity to also spend a little bit of time talking about things like our relationship with China and things like immigration policy. So let's talk about China for one. That was one of the higher level issues that we were going to deal with today. And what I think is important to recognize is that China is certainly growing as a superpower. It is coming to face us in something that feels a little bit like the Cold War that we fought, if you want to say that, with the USSR for a good portion of the 20th century. China is the new rising power, and the way that history plays out, these two powers, whoever the incumbent and the challenger are, there will be some sort of conflict. And we've started to see that conflict happen. We saw it happen under the Trump administration. But it is important to remember, I think, that being tough on China as an ideological foe, as a trade-related foe, as an economic foe, is a bipartisan issue. Both Republicans and Democrats agree that we need to be tougher on China. So just because there's a new Biden administration, just because there is a blue ripple, if you want to say, in Congress, doesn't mean that the trade war that we were fighting throughout the course of the Trump administration is going to end anytime soon. In fact, I think it will continue. Biden will continue to be tough on China. The difference, though, is that I think he'll be a little bit more predictable in terms of his policy approach. Now, we know that over the last couple of weeks, as the Trump administration was exiting the White House, there were a couple of very confusing policy changes as it related to U.S. investors' ability to invest in Chinese companies. Certain companies blacklisted, then removed from that blacklist, then put back on the blacklist, then removed from that blacklist. That sort of unpredictability that we saw in terms of the policy approach toward China, I think will go away in this new administration. So expect disruptions at a global level. Global trade volumes will fall. The economies around the world will suffer a little bit, as they did in 2018, as they did in 2019. But we do think that the path towards U.S.-China relations will be normalized relative to where it was over the last 4 years. And for that reason, we continue to believe in the viability of Chinese equities in a portfolio. I think you just have to be careful about where you're allocating. I think you have to work with managers that know what they're doing in that space. And we can certainly get to that point later on when we're talking about the investment implications. The other thing that I'd like to mention here is what else Biden can do through executive action. And one of the things that Joe Biden can do through executive action, so without congressional support, is change immigration policy. We know that he has rolled out a program to change the way that the so-called dreamers in this country are handled. That was a program started by the Obama administration. There are a number, millions of undocumented younger immigrants here illegally. There would be a path to citizenship. Now, this is very controversial and certainly very political. But if I can take a step back here, I think what we can expect out of the Biden administration is a friendlier policy in general towards immigration. We saw under the Trump administration, the State Department issuing fewer consecutive visas every single year, net immigration falling every single year. And that was in line with Trump's America First policy. It was perfectly legitimate given his approach towards policy. But the issue that we face right now is that the US economy is a very mature, developed economy. And if you think about growth as being a combination of growth in the labor force and growth in productivity, well, our domestic birth rate is very low. Immigration was on decline. It was very hard to see a growth in the labor force over the long term. A change in immigration policy where we issue more visas to foreigners, highly qualified, highly skilled foreigners to come in here and work in jobs that we simply cannot fill because we don't have enough population growth. That would be a good thing for longer term growth potential. But the other thing we see from growth potential, and we can kind of weave in this other topic here, at least partially talking about this, this fourth industrial revolution, is the change in technology. As I mentioned, there is this relationship when it comes to growth. You need an increase in labor force, which could come through immigration policy change, and an increase in productivity. Now, that's something we haven't seen over the last 10 years. Productivity has been declining for actually many decades. But this fourth industrial revolution that, Stefan, you had mentioned at the beginning, this technological revolution that we're seeing now is having enormous impacts on productivity, impacts that I don't think are being fully measured using today's tools. Most of us, if not all of us on the line, probably have a smartphone in their pocket, right? This is a supercomputer in your pocket. It's the size of a deck of playing cards. You have instant access to all of mankind's history and information and knowledge. I don't know if we can fully measure just how impactful that is, aside from how distracted we can get from social media browsing, right? There are bigger implications here. I think we will start to see them get sort of woven into the broader story in the decades to come. And so things are changing right now. And I think a lot to look forward to in the coming decades. Now, let's move to the last agenda item here, which is going to be to talk a little bit about those investment implications, right? So we've just laid out all of these different things to think about. How do we think about asset allocation in today's world? When I think about asset allocation, I find it very helpful to divide the world up into the winners and the losers. All right, figure out who's winning, who's losing. Figure out why that's happening. Figure out what about those circumstances, if anything, is going to change. Figure out why or when those circumstances will change. And if we can answer all of those questions, then I think we can have a more informed view as to how to allocate our assets. To my mind, one of the biggest losers out there is the bond market as a whole. You have coordinated central bank policy easing all around the world, coupled with a very severe global recession that pushed bond yields to near record lows. Remember, during the depths of the pandemic last year, 10-year Treasury yields hit around 30 basis points, a number we have never seen before. And yes, there has been some rally in yields over the last 9 months or so as the economy starts to get back on its feet. But as we can see on page 42 from our guide to the markets, the yield environment, which we show on the left-hand y-axis, is the lowest it's been in 25 years. Although given the broader trajectory in interest rates, probably the lowest it's ever been in history. Sub 2% yield on the Barclays US Ag. It means that high-quality US fixed income, when you incorporate the impact of inflation, barely breaks you even, and perhaps even in some instances causes you to lose money in real terms. And so a lot of investors wonder, why do we need to be invested in fixed income anyway? What is the benefit of buying bonds in a world where the yield environment is so challenged? And I think we have to acknowledge that yields are pretty abysmal in the fixed income space. But at the same time, I think we need to recognize that you own fixed income for more than just the income. You also own it for protection. And what we show on page 42 is that while the yield environment for fixed income is not particularly good, there is still some protection to be found. If you look at the right-hand axis of this page, we show the return potential of the Barclays US Ag if fixed income yields fall to zero. Now, let's think of yields falling to zero as being kind of a proxy for the economy melting down, the stock market melting down. If yields fall to zero, there is almost a 10% total return cushion for your portfolio from bonds. That's that ballast. That's that insurance policy. It's the thing that's going to zig when everything else is zagging. And so despite the very poor yield environment that we see right now, there are still some reasons to own fixed income, higher quality fixed income, moderately high duration fixed income. The issue, though, is that as we move through the course of this year, this story is going to change, and it's going to change quite rapidly. Let's turn to the next page of this presentation, which will be page 37 from our guide. We show on this page that the Fed has told us that it is not going to raise short-term interest rates until at least 2023, maybe even longer if you incorporate that average inflation targeting framework that they have developed for policy decisions. And yet at the end of this year, we think the economy is going to start to really heat up. All of that missing demand or lax demand, as we had talked about earlier, Stefan, it's going to come back. The economy will roar back to life when this pandemic is over. And thanks to all of this fiscal stimulus, we will probably see some inflationary pressure build as well. Now, an economy roaring, inflation heating up, the Fed would normally feel compelled to act. But I think the Fed has backed itself into a corner with what it has done on its dot plot. Forward guidance is probably the most important tool that the Fed has in its tool belt. And it won't want to contradict itself. It won't want to lose face when it comes to policy decisions. In other words, it doesn't want to throw its credibility out the window and cause investors to disregard any future Fed messaging. And so I think the Fed is going to keep rates at zero, even as the economy starts to heat up. The path of least resistance from an interest rate perspective, I think, is the Fed will take its foot off the gas with quantitative easing. It's going to taper its balance sheet purchases. It's going to unwind its its balance sheet. And as a result, long end yields are going to steepen. It means that the yield curve in 2021, we think, is going to steepen as well, something we haven't seen in a long time. And with a steepening yield curve, all of a sudden, that duration story that we mentioned, it doesn't make sense anymore. Those higher quality assets, they become less attractive. I think all of this points to a need to be flexible in fixed income, to be nimble, agile, to be able to work with managers that can navigate what is already a complicated landscape, only becoming more complex as the year unfolds. I think we have to approach equity investing with a very similar mindset here, right? Recognizing the winners and losers, recognizing the challenges that we face, figuring out how to navigate them through a changing, evolving environment in 2021. So let's turn to the next page of this presentation, which will be page 12 from our Guide to the Markets. Page 12 partially shows one of the biggest issues that we as investors are facing right now in 2021, which is that stocks are extremely expensive. We are seeing valuations that rival where we were during the dot-com bubble. And that's because prices recovered a whole lot last year, whereas earnings really didn't pick up that slack. We are left with extraordinarily richly valued equities, and we are left with a lot of investors wondering, why would you invest in stocks at a time when they are so darn expensive? Now, there are a couple things that you could say about that. One of them is that higher than normal valuations are inherently justifiable by lower for longer interest rates. You have to put your money somewhere. Bonds aren't really giving you that yield, as we had just discussed. There's also an argument to be made that the earnings recovery is still happening, and that as earnings recover, valuations will inherently move lower. But what I think is very interesting about page 12 in particular is it shows something else that's going on underneath the hood in the equity market in 2021, which is that the dispersion of valuations, the range of valuations within the S&P 500 is the widest it has been in at least 25 years, probably the widest it has ever been. It means that, yes, there are some very richly valued stocks in this index, but there are also some value opportunities. Still some places where we can find value in 2021, even after that extraordinarily good year in 2020. So let's turn to the next page and try to identify some of those options. Page 16 looks at returns for sectors and industries within the S&P 500 since December 31st, 2019. So pre-pandemic numbers here. The winners and the losers on this page, this should really come as no surprise. Online retail, infotech thriving because of the pandemic. Meanwhile, things like energy, airlines, brick and mortar retail, financial institutions suffering for the exact same reason. But how do we make sense of all of these things and translate them into some longer-term actionable investing ideas? Well, one of them is that I want to recognize that there are long-term secular trends out there. Healthcare is a good example of that. We are an aging population. There is enormous developments happening in the healthcare sector. We are used to a specific standard of living. We are willing to pay to maintain that. But the other, and I think more exciting opportunity that exists out there is technology. Right? Tech is a part of everything. You can very easily make the case that most sectors in the S&P 500 are one way or another becoming technology oriented. Right? They use tech to interact with customers. They use tech to improve efficiencies. Technology is everywhere, not just in the tech sector. But if we look at things like the tech sector, like the technology adjacent sectors, like interactive and digital media within communication services, like online retail within consumer discretionary stocks, we see this as a long-term trend. I don't think anybody would make the case that technology will be less important 10 years from now than it is at this very moment. And so we can rely on those long-term secular trends, those growthier parts of the market for long-term portfolio performance. But at the same time, we do want to balance that growth allocation with some newly created value opportunities. And as we had discussed on the previous page, there are some. If we look at the right-hand side of this page, the cyclical parts of the market are probably beaten up. And they have a nice valuation tailwind baked in this year as the cycle starts fresh, as the economy recovers. Things like energy, things like airlines, broader industrial should perform well this year as they play a little bit of catch up relative to the winners of 2020. But the single best opportunity that exists in markets today, I think, is still large cap US banks. They're still underperforming relative to where they were at the start of 2020. They were unfairly punished last year for their loan loss provisions, despite the fact that their underlying credit quality of their borrower is still very high, despite the fact that their businesses are positioned very well, that their balance sheets are ironclad, that they are extraordinarily well capitalized. And as we move through the recovery this year with a steepening yield curve, which is inherently beneficial for net interest margins, we expect very strong performance out of the financials sector. And of course, overlaid on top of all of this is going to be that ESG story, environmental, social, governance, getting woven into all of the ways that we are thinking about investing. Many companies in the stock market are considering ESG when it comes to governing their companies, when it comes to investing. And the ESG of today is not necessarily the ESG that we are used to thinking about from the years past. It doesn't necessarily mean not owning gun stocks or not owning oil stocks. It's about how companies are evolving throughout time to make themselves more efficient, to make themselves more future-proof. And if you think about this incoming Biden administration as being more left-leaning, more willing to issue regulations around things like energy, it seems that like for at least the next 4 years, there is going to be some very strong opportunities for environmental, social, and governance-related investing. We're sort of putting that as a layer on top of all these individual sectors and industries that we think are going to do well. The other thing that we should start to do is look outside of the US, because while there are some very exciting sectoral opportunities right here, there are a lot of very exciting geographic opportunities as well. So let's turn to the next page of this presentation, page 52 from our Guide to the Markets. I'd like to draw everyone's attention to the bottom right side of this page, the representation of cyclical and technology sectors. It shows, as we had talked about earlier, that the U.S. market is dominated by technology. Almost 30% of the S&P 500 is tech. By contrast, the rest of the world doesn't have nearly the same tech exposure, and that can help to explain its underperformance relative to the U.S. over the last decade, over the last 12 months. But as we move through 2021, as the global economy gets back on its feet, as we move through this recovery, the cyclical upswing should, in theory, lift those more cyclically sensitive sectors and countries, places like Japan, parts of Europe, certain emerging markets, all riding that cyclical tailwind alongside an already existing compelling valuation argument, compelling income-oriented argument, and the fact that we expect the dollar to weaken throughout the course of this year as interest rate differentials have narrowed and the global economy gets back on its feet. We also see particular excitement out of the emerging world, especially Asia. Places like China, as we had mentioned, but also Korea, Taiwan, Vietnam, India. These places have a heavy exposure to manufacturing, which means they are, again, cyclically exposed. They have a heavy exposure to the consumer, not a lot of exposure to commodities, and probably the most exciting of all, a very large and rapidly growing middle class. In just India and China alone, over 1 billion people will enter the global middle class over the next 10 years. That is an enormous aggregate purchasing power that will enter that global marketplace. It is an inexorable force. It is a boon for foreign companies doing business in those countries. It is a boon for domestic companies as well, as those consumers start to turn increasingly inward and buy from their own providers rather than importing from foreigners. Now, at the end of the day, though, what this really boils down to is that we can make a lot of assumptions about where things are going throughout the course of 2021. It should be a good year, but there are a lot of conditionals, right? There are a lot of clauses. There are a lot of what ifs. And so nothing that we've just talked about, no matter how much you like the story, is guaranteed. It's not set in stone. And so what we have to do instead is recognize that we can prepare for volatility and protect ourselves through broad-based diversification. So let's turn to the last page of this presentation, page 71 from our Guide to the Markets. We show on this page a synthetic asset allocation portfolio. It's a little bit of this, it's a little bit of that. It's all of these themes that we just talked about slammed into one. Now, you'll notice that in any given year, you're never going to be the best performer with asset allocation, but you'll also never be the worst performer. You're going to be right in the middle, that comparatively smooth and pleasant journey. And Stefan, I know you mentioned at the beginning, you are inherently longer term focused investors, set it and forget it. Well, the best way to do that is to avoid volatility, avoid those potential pitfalls. And we do that through broad-based diversification, because asset allocation across styles and sectors and sizes and geographies, well, that'll help us to smooth out that journey and help us to really ensure that longer term investing success. Thank you all very much for the time. I hope this was helpful. And Stefan, I will pass it back to you.
Great. Thank you so much for all that amazing wisdom that you shown us. And absolutely, that last slide that you took us through, I mean, some people call it the periodic chart, but as you could see, not one asset class stays on the top for a long time. And so that's why, as you mentioned, through strategic asset allocation, that's one of the ways we like to align the portfolio. And again, thank you for the amazing data. As you know, we're very data driven. And one of the things that caught my ear was when you were speaking about interest rates. And we were just speaking with clients in the UK who locked in a 25-year long-term mortgage for 1.6%. So obviously we're in this era of very ultra low interest rates. Another factor that comes along with it, though, is will we see inflation ever? And one of the statistics that could be alarming is by one measure of cash circulation, we saw money supply increasing by $3 trillion or so last year in the US. So any thoughts around that?
Yes, absolutely. I'd be happy to share. And Matt, I know we have the broader guide to the market. If you forgive me, I don't know the exact page, but Matt, if we could put the inflation page up on the screen, that would be very helpful. It should be in the 30s or so. But while we wait to get that up, there is a lot to say about inflation, Stefan, and I'm sure you're not the only one asking this question. Everybody wants to know, is inflation coming? And what I think is really important to remember is that, first of all, the U.S. economy has been very resilient in the face of inflation, really over the last 30 years. And we've been able to avoid core inflation moving above 3% or below 1% since the early 1990s. That's pretty remarkable. Inflation got way out of control at the end of the 1970s. Paul Volcker whipped it into shape by throwing interest rates up, slamming the brakes on the economy, causing a pretty steep recession. But thereafter, things have been more or less under control. And there are a couple of reasons why inflation has stayed under control for the last 30 years. One of them is that we have a very large trade deficit, right? Some of it's with China, some of it's with other trading partners. But when we can buy our goods made cheaply somewhere else, we avoided a lot of those inflationary pressures. The other thing that we've seen happen over the last 30 years is the rise of online retail, of e-commerce. right? You can go online and buy basically anything under the sun and have it delivered to your place pretty quickly. And chances are get a pretty good deal on it, right? Price discovery right now from a consumer perspective is the best I think that's ever existed in the history of human commerce. We have never been this informed as consumers as we are at this very moment. And those two developments, I think, have done a really good job of helping to keep inflation under control. The other thing that has happened more recently is that the United States has come online as the swing producer in global energy markets. And if you think about what contributed to that runaway inflation in, say, the 1970s, early 1980s, thank you, Matt. One of the things that contributed to that runaway inflation was the surge in oil prices that we saw, right? There was that OPEC embargo. You had people lined up to get gas, certain license plates getting called. We are never going to see that again. With the shale oil revolution, with the fact that we are moving towards a greener sort of future at some point down the line, you will never see oil hit $150 a barrel. It's just not going to happen. And so with oil more or less under control as the U.S. Has emerged as this swing producer, it's another reason why we don't think inflation has been able to get really out of line for the last 30 years. Now, what about this time is different? Well, as you mentioned, the money supply has ballooned right now. There's been a ton of liquidity injected into the markets. Rates are very low, but also, as we know, there's been trillions of dollars of fiscal stimulus, more to come, it seems like. And that's on top of the trillions of dollars that we added to the debt when we cut taxes back in 2017, on top of the trillions of dollars that we added to the debt in the aftermath of the GFC. We have been very rapidly expanding that for quite some time. This time is different, perhaps, because this stimulus has been directed disproportionately towards lower income, lower wealth individuals, right? These are the people that are unemployed because of COVID, the people that work in retail, travel, leisure, hospitality. They're the ones that are getting the benefits of this fiscal stimulus. And we know that lower income individuals have a much higher propensity to spend additional dollars. Right, if you give somebody that makes $25,000 a year a $1,200 stimulus check, they're going to spend it almost immediately, maybe on rent, maybe on food, whatever. If you give somebody that makes $250,000 a year a $1,200 stimulus check, it's probably going to go into their savings account. Maybe it'll go into their brokerage account. It'll go into assets, not into goods. And so with all this money sloshing around, with all of this pent up demand that we had talked about, there is the very real potential for inflation to bubble higher. Now, I still think that those structural anchors like the trade deficit, like e-commerce, like our position as a global energy powerhouse, prevent inflation from getting up to the high teens, like what we saw at the end of the 1970s. But could inflation breach the Fed's 2% target for the first time in a long time? It could. I don't think it's going to happen tomorrow because there is still a lot of slack in the economy. But as we move into the second half of this year, as we move into 2022, as we spend more money from a fiscal perspective, I think investors should prepare themselves, at least partially, for a little bit higher inflation than what we're used to. And Stephen, the way that we've been handling this is trying to figure out how to hedge against it. So one of those things can be inflation-linked bonds, TIPS in this country, Treasury inflation-protected securities. That's one of the ways to do it. Commodities is another one. Owning things like gold are typically a pretty good hedge against inflation. So it's coming. I wouldn't be pulling my hair out over it because I don't think it's going to be the nightmare that we had at the end of the 1970s. But I do think there is some room for inflationary pressures to build.
Right, and naturally, stocks are a great places to be long term because, if you're, as a simple example of McDonald's with hamburgers may have cost 30 cents 30, 40, 50 years ago, they have the ability to continue to price it up and thereby rewarding the stockholders. Isn't that right?
Exactly. It passes right through.
Exactly. Perfect. And given the time, obviously amazing responses. Thank you for that. And
sure.
At some of the questions, just wrapping that up with maybe two more. Given the money supply that you've mentioned and you guided us through the various potential scenarios, are you concerned about the deficits that are continuing to go up? How will that play out? Is it just simply that we have to accept higher taxes?
Mm-hmm.
What are some of the things that you're seeing on your end?
There is a lot of concern about that. And I think that a lot of people have seen some pretty high profile government level defaults over the last decade, right? Greece was a big one. It caused that Eurozone debt crisis. We've seen Argentina and Venezuela, a lot of Latin American countries going through similar issues in more recent history. I think, first of all, it's important to remember that you cannot treat governments in the same way as you treat households, right? The government does not have to run a balanced budget in the same way that you and I have to, right? Eventually, we have to spend less than what we take in, or at least spend as much as what we take in. The governments don't necessarily have to play by those same rules. The United States is unique, though, because we have a Treasury Department that prints the world's reserve currency. And the US dollar, I believe, will stay the world's currency for a very long time. There are really no true pretenders to that story. And then we have a Federal Reserve, which is in effect the world's central bank, willing to buy up a lot of that debt, to monetize the debt, to keep rates lower. And so I don't think we're heading towards a default. I don't think we're heading towards a currency crisis. I don't think there's like something cataclysmic coming down the road because of all this money that we spend. But I do think at some point we're going to have to do something to rein in the deficit. And the reason we're going to have to do that is because right now rates are very low. And right now the interest payments as a percentage of GDP are only around 2 or 3%. They're very, very manageable. But as that debt gets higher, as those rates move higher, that number is going to get bigger and bigger and bigger. 3% is okay. 10%, that's a little crazy. Right? Maybe you start to move to 15%. That's a little crazy. How do you deal with that? Well, one of them, Stephan, you mentioned higher taxes. I really think that we need to start thinking about higher taxes as an inevitability, not a question of if, more a question of when. And when you consider that, when you compare the United States to a number of other developed countries, we actually have one of the lowest individual tax rates in the developed world. So there is room for that number to move higher. And I know nobody wants to think about it. I don't want to pay higher taxes, but we're probably going to have to at some point. The other thing that we're going to have to deal with, I think, is reduced entitlement benefits. There needs to be entitlement reform. That system is not working the way that it was designed to. I don't know when it's going to happen. I don't know how it's going to happen, but things like Social Security, things like Medicare, there will be adjustments to those as an effort to save money because they are very fast growing portions of federal government expenditures. So at some point down the line, higher taxes, worse entitlements. It means that what is already a retirement, there already is sort of a retirement issue. It's only going to get worse. And so I think to me, it's a big call to action for anyone out there to save more of what you earn, to invest more of what you save, to take more risk in portfolios, and frankly, to work with people like you, to set up these longer term financial goals and work towards them because it's only going to get more complicated in the future.
Right. And we have so many amazing questions and comments, but I'll leave you with this last question. Given that you mentioned US is the global reserve currency at the moment, but potentially one of the competing asset classes, if you will, is how do you see cryptocurrency playing a role in the world, given that it's really starting to gain more traction as of late with institutions coming in. So back to Jack. One last question.
I'm very sorry about that. I'm not sure what happened. Could you repeat that question?
Yeah, no, absolutely. So basically, you mentioned the U.S. as a reserve currency.
Yes.
But one of the potential competing asset classes out there as of late is cryptocurrency really gaining more traction, whether it's institutions coming in or just mass media outlets covering more as of late. So how do you see that asset class? And obviously, there's another discussion between Bitcoin versus the blockchain technology itself.
Right. Just
an overview of that would be helpful.
Sure. And I promise I did not deliberately try to avoid your question about Bitcoin. That wasn't a ploy to dip out. So I have a sort of, I don't even know if it's controversial. I know that people have very firm opinions about cryptocurrency and Bitcoin. It is basically impossible to be neutral on the subject. You either think it's the best thing that's ever happened or the dumbest thing that's ever happened. Now, I look at Bitcoin, and I'll share an anecdote with everybody on here. I'll humanize this a little bit. My best friend from college is a really smart guy, right? I went to the University of Chicago. It's a good school. He was a physics major at the University of Chicago. So that's a tough major. And then he went and got his master's in physics, also at the University of Chicago. He taught for a while, really smart guy, huge Bitcoin believer, loves it, thinks it is the future. And you know what? Turned a couple $1,000s into $750,000 in a few years based off of Bitcoin. And the whole way through was telling me, Jack, you got to invest. Jack, you got to put money in. And the whole time I was like, you're an idiot. This is stupid. And now I look like the stupid one, right? Like I look like the fool because here he is sitting on all this money that he hasn't done anything to deserve. Frankly, I'm happy for him, but he hasn't done anything to deserve this. And you know, I'm kind of on the sidelines, and I feel like a lot of people are out there like that. You know, they hear these rags to riches story, this incredible potential for wealth generation. I mean, we've seen it happen recently. But when we think about cryptocurrency as a true currency, right, there are two big things you have to think about when it comes to any sort of like the sort of idea behind fiat money. One of them is that it has to be transferable for goods and services. And as things stand right now, Bitcoin really isn't. You know, there are some places that will accept Bitcoin or other cryptocurrencies, but you can't walk down the street to Starbucks and pay for your latte with Bitcoin. You just can't, right? Like most things that we do, you can't go to McDonald's, like you were saying, and buy your Big Mac with Bitcoin. You just can't. It is not particularly useful as a currency because you can't really spend on anything. The other thing that fiat money is supposed to do is it has to be a store of value. So, you know, I know that if I sock $100 bill under my mattress, that a year from now, it will more or less be able to buy me the same thing. You know, maybe there is some inflation, maybe $100 turns into $98 in terms of real purchasing power, but it's more or less the same. That is very clearly not the case with Bitcoin. I mean, Bitcoin went from, you know, $6,000 a coin to $40,000 a coin in a year, and then went from $40,000 a coin to $30,000 a coin in like a week. I mean, that's not a store of value. There is no protection whatsoever of the value that exists there. So as things stand right now, I think Bitcoin's very silly. I think you should treat Bitcoin like you treat going to a horse race or going to Vegas, right? I mean, it's not to say you shouldn't do it, but I wouldn't treat it as an investment, because you can't like invest in something like Bitcoin. You really have to think of it almost as gambling. That's how I feel. Things can change moving forward. You know, you're absolutely right, Stefan. There is more institutional adoption, which means that it shouldn't be as wildly fluctuating in the future. And because there's more institutional adoption, maybe you'll be able to use it for more things down the line. But as things stand right now, I don't really like cryptocurrencies a whole lot. And maybe, you know, as I have been for the last few years, I'm going to be left, eating crow in 10 years from now when everybody pays for everything with Bitcoin, maybe. And that's very fair. You know, we talked about this technological revolution. It is certainly part of it. But I liked what you said, Stefan, earlier, which was drawing the distinction between Bitcoin and the blockchain. So Bitcoin runs on the blockchain. The blockchain, I think, is without a doubt the future. Without a doubt. And there are many companies that have adopted it. JP Morgan, for example, already works with the blockchain. When you think about how the blockchain streamlines things like the transfer of ownership, it is amazing. You know, why should it take 3 days for me to transfer money from my savings account to my checking account if I have two different banks? It shouldn't. Right? I mean, there's the internet, right? There's high-speed internet. You can do it like, if I can hit a button and have it confirmed in a microsecond, then a bank should be able to hit a button and send it in a microsecond, but it can't. Bitcoin enables that. If you were to buy a house, you got to put your money in escrow, right? You do this for months. You have this sort of limbo. Why? You know, why can't I physically hand you the deed to my house? Now it's your house, right? Why can't you hand me the cash? Now it's my cash. You can do that with Bitcoin. And then you think about things like settling derivatives, settling options trades. You can do that instantly instead of T+1 or T+2 or T+3. There are a lot of real world applications for the blockchain that are enormously beneficial in terms of efficiency, productivity, things like that. They are already getting adopted. So if I want to be kind of boring here, the way I would get my exposure to this whole thing, rather than buying some Bitcoin, you know, if I had $10,000 to invest, rather than put it into Bitcoin, I'd invest it in a company that is really leaning on blockchain technology to improve its efficiency and productivity over time. That's how I would take that exposure.
Great. Yeah, no, absolutely great points. And you know, one of the things that we do as an evidence-based investor is really look at fundamental ways to value things. And as you know, with a stock, whether it's cash flow, profits, revenue, there is a way to value certain things given the interest rate time frame. As with crypto, it's really hard to do that. And to your point, you know, that's where things are a little bit up in the air. So, you know, great insightful points. Thank you very much.
Of course.
And yeah, we're looking forward to having you in the near future again. Really appreciate your time. And if anyone has any more questions, please email us. We'll be here to answer all of your questions. Again, thank you very much. Appreciate it. Have a great week.
Thank you, everyone.
Bye-bye.